Today's class I'm going to showcase how to use our 3.0 containment bands. And the main reason for doing this class today is because the markets were really weak today, and what you'll find is even on the weakest day like today, if you follow this system, you'll have some small losses, but you will also catch some nice wins which will cover your losses and leave you with some pips most of the time. So the 3.0 containment band, let me just bring up what it looks like. When you add it under Add Studies, the containment bands, you want to have 20 days and the multiplier be set for 3. And I use these mainly on the 60-minute bar, although traders have told me that they use these on multiple different time frames, 5, 15 minute, 30, and so forth. And it finds more trades, obviously. These are typically wider apart on the hourly chart. And I like to make mine green. So the green 3.0 bands are pretty much where the market's going to reverse. And the euro dollar was extremely weak today. Let me just showcase the currency meter. Very strong dollar on all time frames. Very weak euro on all time frames. So in showing this today, keep that in mind. Typically, what you want to do is once the currency gets underneath that 3.0 band, especially if you see a little double bottom like this, as soon as it goes above the trailing stop, you're in, and you can see you only made about 6 pips in this case. If you got out with the trailing stop, it did go up another 5 pips there. Came down again. Usually you want to kind of wait and see what the weakness is. And this one kind of went down and went sideways. If you had bought the breakout above that trailing stop here at 93, you can see you got out here at 89. So the losses when the trade doesn't work is very tiny, 4 pips. And usually when it goes sideways and you get into a trade or two and it doesn't bounce, you're better off waiting for the next wave down. Draw your fibs, just be a little patient. In this case, it didn't quite hit the 1.382 band, so I probably would have myself avoided this. But again, if you wait for a breakout, in fact, most of the time I'm looking for a breakout of the sideways range, so I would have had to go a pip above this. So trigger would have been right here at 77, and you got stopped out at 65. So you can see in that case it was a losing trade. Most of the time you're better off waiting for it to come down between the first and second fib target and then look for a bounce. So I would have avoided that trade, but I would have probably taken this at 52, out with a tiny loss. You draw your fibs on the second wave right there, and you have another loss right there. But the whole point of trading is, and one of the reasons for me doing this video today on a super strong trend down, is that when you draw the fibs on there, eventually you get into a trade here at 21. You can see you lost 4 or 5 pips. You got into it here at 19, and it went all the way up to 44. Went up about 20 pips. If you bought this little pullback here, because it double bottomed, you can see it went up about 15 or 20 pips. Even if you got out here with the trailing stop, you made 10. So if you make 20, 15, that's 35 pips. If you have a couple 4 and 5 pip losses and even a 10 pip loss trying to get into the trade, you can get it back with one nice size move. Let's take a look at the pound. This one did not quite hit the 3.0 band. Here's the euro yen, and this is oftentimes what happens. It comes down to that band. You get in here at 34, out at 34, pretty much break even. In here at 17, out at 27, you made 10 pips. And you can see it went kind of sideways there. It's extremely weak. And most people who trade counter trend are going to be very cautious looking for buys. If you got in right here, you have a small loss. You get in right here, you pretty much break even. If you get in again here at 09, let's scroll forward. It went all the way up to 23. The whole point of this is typically at this 3.0 band, it's not going to go down anymore, and you can get into some nice scalps. This one from the low here at 06 went all the way up to 38. This one from the low right here at 93 went all the way up to 24. So the point is, when you get down there, and especially when it kind of goes sideways like this and the weakness kind of falls off, you can get into some trades where you can catch, usually 10 to 30 pip profits. And the reason, again, I did this class today is because it was such an extremely weak day that I want to showcase how powerful this 3.0 area is. Typically, on most days where maybe 1 or 2 currencies is trending, but not all of them are, when they hit these bands, you'll oftentimes get 30 to 50 pip counter trend moves. Let's bring up the pound yen. And I have this on a range chart underneath, and I'll scroll up here. Notice how it just tagged that 3.0 band here at 27, and it worked its all the way back up to 87. If you have a bunch of small wins, small 5 to 10 pip losses and some 10 and 20 pip wins in other currencies, and you get into this, let's say at 26, and you wait for a two-wave move up, and you got out somewhere up here at 61. One nice trade like this can totally recover, the losses that you've had. And whenever you see a currency get down to this level, kind of make its way up and come back down again, and it can't quite get back down there again. It's not quite as weak as it was before. The monthly trend's not blood red like you had with the euro dollar and euro yen. Typically, when you get a little mini double bottom pattern on this, you can also take another trade a little bit later here at 49, out here at 62. For another 12 or 13 pips. It's just a wonderful way of finding some big pip wins. Here's the dollar Swiss. I will put on the containment bands with the 3.0, which I don't have on this particular chart. Put the 3.0 right here. I like to black out the center channel because I already have that on here, the hourly moving average. Make the max band green. And you can see when the market gets up to this level, it usually kind of runs out of steam. And there's a lot of times a reversal. And especially as I zoom in here by hitting the plus key, we have a fib target right here. And let's say you went short once it fell down here at 73, your stop's a few pips over the high. Kind of goes your way, comes against you, comes back down. You can see it's not that weak. But nonetheless, if you're short here at 73 and it's kind of going sideways and you're out here at 62, you made your 10 pips. And when it comes back up again, it can't even come back up to the highs. You have a nice shot here at 70, comes all the way down to 57. There's many opportunities using the 3.0 band to catch, 5 pip at the smallest, up to 50 to 100 pip counter trend moves off of these 3.0 areas, because rarely do they go against you. Now, I'd like to end this class by saying one thing. Sometimes the market goes up to these 3.0 bands, but the weekly and the monthly trend is down. And when that's the case, you can usually scale into some trades. A lot of times I will get into a trade, let's say it comes up here and goes sideways, it goes my way a little bit, comes back up, comes back down underneath this area. That's very positive. I'll add to my trade. And then it comes back down and make 10, 15 pips. Let's say I shorted it right here at 73. When it broke out and came back down, I might be short at 78. My average price is 76. I have 2 positions on. If it comes back down and kind of goes sideways without that much weakness, let's say I made 10 or 11 pips with a double-sized position, that's equivalent of a 20 pip win right there. Here's the dollar CAD, and this is the 5-minute charts. I don't have the containment band showing the 3.0 area, so we'll add it again. It's very easy to do. 3.0, boom, black. Make these bands green. It might not have hit it in this case. And you can see what happened here. Just a pip or two away from it. And the first really explosive move up, I might not take this trade right here, even though it did pull back about 10 pips. But when it came up and made a little higher high right there with less momentum, this is pretty much a no-brainer. It's kind of going sideways right here. It might be short at 64. Goes a little bit my way, comes back up. Can't take this high off. I'm going to add to my position here. And as it pulls back down to 46, you have a 10 or 14 pip win there with a double-sized position. And if you went short again when it came up to this high and really failed to go higher and it starts coming down at 66, kind of going sideways right here, you had a chance to make a few pips there as well with a smaller position because it didn't, anytime you see a false breakout, if you're in a trade and it doesn't quite stop you out and then it comes back down, false breakouts like this and the other one I just showed, usually I'll add to my position size. If you catch 15 pips with a double-sized position, it's like a 30 pip win. Which again, as you saw by using the range charts and the trailing stop to get in and out, usually the losses are 4 to 6 pips. You catch one 30 pip win, you're left with a lot of pips in your pocket. And on very strong trend days like this is the reason why I did this as today's class. It's a very easy way to add pips to your account on a weekly basis. And hopefully, if you're not taking stupid trades that have nothing to do with the systems and the tools and the methods that we teach in our class, then you'll be left with positive pips at each week. This is a great strategy to add to your trading repertoire because it tends to find net positive trades if you take all of them. Here's the CAD yen, which again, I don't have the containment bands on a 5-minute charts, but I'm going to just add them here. It's very fast and easy to do. And you can see it just went right down to this level right here, 57. And a lot of times if you, on a 5-minute chart or a range chart, if it kind of goes sideways for a little bit and goes above those bars, let's say it's 63, it went all the way up to 84. It went up 20 pips. And it came down again. Now, this is a little riskier. I wouldn't trade my normal lot size when I see this much weakness. However, like I said with the other example, this one has a weekly and a monthly trend that's up. So it's extremely weak today, but the longer term trend is up. So it's definitely a better trade to find and buy the lows when the weekly and monthly trend is strong like this. The monthly trend was extremely strong until 5:30. The weekly trend was still strong. This is a nice little move here. So you have two 15 to 20 pip moves right there that you could profit off of, and it's a good scalping method to get your 10 to 30 pips a day. I'm going to finish up with this example. It's Australian dollar. It was also one of the weakest. Australian yen, one of the weakest currencies today, using the currency meter. We'll put the 3.0 containment bands on here. And you can see it probably didn't quite hit it in this case. This band was right here at 27. It came down to 30. If you're looking at this currency, because the daily, weekly, monthly trend was down, I probably would not have taken it. If it was a few pips away from it right here and the weekly, monthly trend like the previous example was up, I probably would have taken it. The fact that it came down to this level, it's also my Fibonacci profit target level I do each night. This is an area where I'm expecting to be the low. I'm not going to buy it the first time. I might have bought it the second time. I'm definitely buying it the third time. If it can't penetrate that area 3 times, it's going to go higher. And you can see right here, if you're in at 36, went all the way up to about 80. So 40 pip win. It only takes one of those to get rid of a bunch of 5 and 6 pip losses and 10 pip losses. So again, if you take a bunch of trades at these 3.0 levels or very near it, if it comes within a few pips and then has a nice pattern trade on it too, or it can't penetrate a major support area, you're going to get usually a 20 to 30 pip counter trend move.